They're trying to give me, but like, there's nothing to give me.
You have to.
It's not like you went into the
They didn't, I didn't
It's
get
not like
it.
he just said they got here.
No, he's just going.
Okay, let's go ahead and get started. Think we're ready to go. All right. So we're going to talk about chapter 4. Chapter 4 is a long chapter, so it will take us a little bit of time to get it done. We'll probably finish it, a couple class periods. So chapter 4 is all about gross income. So we talked about gross income before, right? If you're looking at your 1040, page 1, gross income is in that top half of the page. These are the things that are, we're not really in this chapter going to talk about exclusions. So remember I've talked about that code section 61A, that says gross income includes income from all sources derived unless there's an exception. Okay. So that unless there is an exception bit, that's all the exceptions to gross income are really covered in the next chapter, in chapter 5. So you might be thinking, okay, so if we're to assume that everything is gross income unless there's an exception, and the exceptions are covered in chapter 5, why do we have this long chapter, and it is a long chapter, on gross income? Shouldn't we just assume that everything's gross income unless there's an exception? So this chapter is really more about not necessarily what is and is not gross income. It's more about when do we include something in gross income? How much is included sometimes. We'll talk about some specific rules like annuities. Well, where part is included and part is excluded. We will talk about some timing rules that talk about when you have to include in gross income. We'll talk about some rules that create income inclusion that you may not think they do. Some specific rules that there's almost, phantom income, not real money in your pocket. But the code says it is actually income. So we'll talk about some examples of that. We'll talk about how you earn income from receiving dividends, how you earn income from being a partner in a partnership or a shareholder in an S Corp. So we'll talk about that piece of it. But as far as actually getting into a big list of things that are excluded from gross income, that won't happen until the next chapter. So with that, let's go ahead and get going. So we talk about our big picture facts from chapter 4. Dr. Payne, he opened his dental practice as a sole proprietorship with the December 31st year end. He also leased an office building and entered into a contract to make some improvements. He used $12,000 of extra money to purchase some stock. This is the result of his first year of operation. He has $385,000 of revenue, some AR as of January 1 of 0, AR as of the end of the year of $52,000. This AR is amounts that has been billed to patients. Okay? During the year we had a contractor. He owed Dr. Payne $4,000 for dental work, and he satisfied that amount by installing solar panels on the medical building. Okay. So, gross income. Code section 61A includes income from all sources derived unless there is an exception. All right, just said that. And I actually talked about a lot of these concepts in the last chapter, so there is a little bit of repeat, and that's because I kind of talk about them before they are discussed in the book because I think they are so important. But I discussed in chapter 3 the difference between income recognition and income realization, right? We did some examples on the board. We said this will produce income realization. And gain realized equals gain recognized unless there is an exception in the code, right? I did talk about that, correct? Okay, I have 3 different tax classes, so I have to make sure I have talked about it in this one. So we do get to this question, all right, well, what exactly is realization? So the term realize is actually defined in the book, okay, it's on page 44. For realization to occur, an exchange must take place, and in the exchange, someone must receive assets capable of being objectively valued. I sort of said this in chapter 3. I used to own this piece of property, I don't own it anymore. Used to be mine, it ain't mine anymore. A realization event has occurred. It has changed hands. It has been disposed of, okay? To have income recognition, there has to be a realization event first, okay? Income recognition can be in the form of cash. You go to Subway, you're a sandwich artist, you make sandwiches, you receive a paycheck every 2 weeks, okay? That's in the form of cash, so obviously that's income. But it can also be an in-kind cash equivalent, i.e. property for services. So we were just talking about Dr. Payne, right? And he said he had a patient who owed him $4,000 for some dental work. And this patient installed solar panels on the roof of his house in compensation for that $4,000 of services. Does Dr. Payne have to include any income from this transaction? Did he receive any cash? No, he didn't receive cash, but what he did receive is services. Services in exchange for his services. Basically, he did dental work and this contractor installed a solar panel. So, Dr. Payne would have income equal to the fair market value of the property or services received. I have a friend, she graduated from law school and she couldn't really get a job, so she took a job in South Louisiana, having her own law firm, and she had many clients who would pay her in all sorts of ways. She had one client who would continually pay her with sweet potato pies. So how much income does she have? The fair market value of these sweet potato pies. Presumably they are very good sweet potato pies. I certainly hope so. Okay? But, if your client was providing you, say, a chicken, okay, for your services, then it would be the fair market value of the chicken, is how much income you would include. Not the fair market value of your services, but the fair market value of what is received, is how much has to be included in income. Income does not include the recovery of capital investment. We talked about this, definitely. I know we have. If you spend $20,000 on a piece of equipment and you sell it for $30,000, how much income do you have? 10, right? That's your income realized, your gain realized. Why not 30? Because 20 of that is your investment, what you have expended. Okay. So, Dr. Payne's facts, he purchased some stock for $12,000. This is his basis, right? $12,000, his basis. He sells it for $15,000. This is his amount realized, right? So how much gross income does he have? $3,000 of gain realized and $3,000 of gain recognized. And will that be capital gain or ordinary income? Capital, right? Because it's stock. If he held it for 5 years, is that long term or short term? Long term, right? Okay. Okay. Tax year. I'll just touch on this pretty briefly. So tax year is basically your reporting period. When does your year start? When does your year end? This is a class on individual income tax. Pretty much all individuals have a calendar year. Your reporting year for taxes starts on January 1st and ends on December 31st. Some businesses have a fiscal year, which is basically any year that is not a calendar year. So a year that does not start on January 1st and end on December 31st. Again, pretty much all individuals have a calendar year. Okay. Now, we're going to talk about timing, accounting methods. Oh, my favorite topic. I hate accounting methods. But it is important to know at least the bare minimum. There are people that specialize in accounting methods, and that's all they do all day is accounting methods, and I think that would be horrendous. So what are accounting methods? We're going to talk about the cash method and the accrual method. So we're talking about it for tax purposes, okay, not for financial accounting. We're talking about cash versus accrual for tax purposes. So really, what's the deal with accounting methods? The whole thing that accounting methods answers is when. When is income recognized? Not if, when. And the answer may be different for a cash method taxpayer versus an accrual method taxpayer. So most individuals are on a cash method. Okay, so we'll talk for a minute on what that means. Who would actually be on an accrual method? So if that individual owns a business, they own a business, they're an owner in a business, and that business has inventory, that business will be on the accrual method. Okay? General rules. Anytime you see inventory, usually it means the accrual method is used. Not always, but usually. Okay. So I want to talk about cash receipts method. With a cash method taxpayer, income is recognized when there is actual or constructive receipt. Cash method. Actual or constructive receipt of income. When the income is earned does not matter. Okay? Let me tell you, I'm still angry about it, which is why I'm talking about it right now. When I was on maternity leave, I got into like a 20-minute argument over the head of HR here, who was trying to tell me that receipt of income is the same as earning it. And I was like, I'm a professor in the accounting department. I don't think so. But I still lost, even though they're all imbeciles, but it doesn't matter. So I'm still very angry about that because it ended up me losing out on $1,500 after taxes, even though I fought hard. And they're like, no, it doesn't work that way. I was like, anyway, but it was over this exact thing right here. So it doesn't necessarily, with the cash method taxpayer, it's when you receive it, not really when it has accrued or when you've earned it. It's when you actually have that receipt of the income. Now notice it says actual or constructive receipt. Okay? So, what does that mean? All right. Constructive receipt is defined on page 49. Okay? The amount is readily available to the taxpayer. And the taxpayer's actual receipt is not subject to substantial limitations or restrictions. So what would be an example of this? If you have a savings account and every month or every year you earn interest on this savings account, but you don't ever actually take the interest out of the bank. You leave it with the bank, it stays in the account. So technically, you have not had actual receipt of this interest income because it is still in the bank. But if you wanted to, you could go get it. It is available to you. It is readily available to you. And what does the second part mean? The actual receipt is not subject to substantial limitations. You see this sometimes with, like, say, stock. If you have an employee who is receiving some stock from their employer, and that stock, say, doesn't vest for 3 years, or it's subject to forfeiture if certain conditions happen within a certain period of time. That means that employee taxpayer would not recognize income until all those restrictions and limitations have been lifted. So usually after a certain period of time, say if you have a vesting period for these options of 3 years, then after that 3 years is when you would have the income. There's the law on stock options and deferred compensation is way outside the scope of this class, which is good because I don't know a whole lot about it other than the very basics, which I just told you. So, okay. And there are some more examples in the book of constructive receipt, such as somebody receiving a check from a client, and you go and you put it in your drawer and say, okay, I'm not going to put this in the bank until January 2nd of next year. That way I can hold off recognizing the income. No, it doesn't work that way because you could have put it in the bank. Yes, you didn't, but you could have. So, let's look at an example here. Okay, this is example 6 in the book. Actually, let's look at this big picture facts first, and then we'll look at an example. On December 31st, Dr. Kane has $10,000 in patient checks that have not been deposited. One check for $3,000 is from a patient who asked him not to deposit it until after January 4th because her account did not contain sufficient funds to pay the debt. So, these $10,000 in patient checks. How much income does Dr. Payne have in, we'll say, 2016, which was when he had the $10,000 in checks? Does he have 10,000 or 7,000? Yeah, he really just has 7. Because the $3,000 from this patient, does he have constructive receipt over it? No, because the patient's told him the money ain't there. There's nothing. There's no money. So there's no actual or constructive receipt of that $3,000. So Dr. Payne would have $7,000 in income to recognize as of the end of the year. Okay, so let's look at an example in the book. This is example 6, which is an example for cash method taxpayer. Dana, an accountant, reports her income using the cash method. In 2016, she performed an audit for Orange Corporation and billed the client for $5,000, which was collected in 2017. So we have Orange Corporation, and she billed $5,000 in 16. And she received payment in 17. And she's a cash basis taxpayer. So how much income does she have in 2016 from Orange Corp? What do y'all think? 0, right? It doesn't matter when she invoices it. It matters when she has actual or constructive receipt, which did not happen until 2017. In 2016, Dana also performed an audit for Blue Corporation. Because of Blue's precarious financial position, Dana required Blue to issue an $8,000 secured negotiable note in payment of the fee. The note had a fair market value of $6,000. Dana collected $8,000 on the note in 2017. So we have this Blue Corp, and we have a $8,000 note with a $6,000 fair market value. So why, this is not a tax question, but why would a $8,000 note have a $6,000 fair market value? What do y'all think? It is probably because whatever is securing this note, so whatever is attached to that note, whatever property, which means if you don't pay, this is the property that you can go after to get paid. That property securing the note is worth $6,000. That's probably why they're saying it has a fair market value of $6,000. Because the property securing the note is not worth $8,000, it's worth $6,000. And if you were to sell this note on the open market, which negotiable notes you can, usually, you would only get $6,000. So that basically means in 2016, how much income does she have? So she's going to have $6,000 in income for 16 because when she receives this note in 2016, she could go and sell it on the open market and get $6,000. Now in 2017, the client paid the full $8,000. She's surprised. She thought, I thought they weren't going to pay anything. So how much income does she have in 2017? she'll have an additional 2,000. That's right, she'll have an additional 2,000. Okay. Now, there are some exceptions to the cash method taxpayer. Just a second. If you look on page 410, they talk about original issue discount or OID. Okay. Original issue discount. So all original issue discount is, it's really interest. When you see original issue discount is basically when there is one big payment at the end of a certificate, and the difference between what was paid and what is received at the end, at maturity, is basically interest income. But it really is interest income. But the fancy name for it, or the technical word for it, is original issue discount, or OID. So this is when you purchase some sort of certificate, okay, and then you receive a payment at maturity. The difference between what you paid, which is your investment, okay, and what you receive is really interest. But because you're receiving it, so the question is, with a cash basis taxpayer under normal rules, if they have a certificate and they pay $20,000 for it in year 1, and then at year 4, the certificate pays $25,000, how much interest income do we have? $5,000, right? Okay? But of course, this question is, well, when do we recognize it? Do we wait until year 4? So a cash method taxpayer, under the normal rule, you would say yes. Why? Because they have to have actual or constructive receipt. When do they have actual or constructive receipt of that $5,000 of interest? Not till it's paid out at year 4, right? Well, this is an exception. Under this rule, we say, okay, the code says, instead of waiting till it's received, we're going to make you pay taxes on it when it's earned. See, these words are different. Receipts versus earned. They're different words. They mean different things. Okay, so we have to pay taxes on it when it is earned. Okay, so if we look at an example, this is example 14. On January 1st, 2016, Mark, a cash basis taxpayer, pays $82,645. Right here, $82,645 for a 24-month certificate. The certificate is priced to yield 10% with interest compounded annually. 10% annual. No interest is paid until maturity, when Mark receives $100,000. So at maturity, we have $100,000. So how much OID do we have? $17,355. So we want to know, great, well, how much income do we have to recognize in 2016 versus 2017? So in 2016, we have the amount that he paid, $82,645, times our interest rate, compounded annually, which is 10%, which gives us $82,645. $82.65 in 2016. Now what about 2017? So it is compounded annually, yes. Okay, so we have our 10% times 82,645 plus the interest from 2016, which gives us 99. So we will recognize this amount in 2016 and this amount in 2017, even though this taxpayer does not actually receive the income until 2017. Okay. I will say there is an exception to the exception. In these bonds, these Series E and double E bonds, we're not going to do an example, but just know that these bonds are kind of the exception to the exception, which says that they're not subject to these special OID rules. Okay. Now, we have, what is the accrual method? Income is recognized in the year that it is earned. So what is earned? The year earned is what is important, regardless of when it is actually paid. Income is earned. So this is a defined term for an accrual method taxpayer. Income is earned when all events have occurred that fix the taxpayer's right to income. So earned when all events have occurred that fix the taxpayer's right to income, and the amount can be determined with reasonable accuracy. So if I'm an accrual method taxpayer and I send an invoice to a client at the end of 2016, but I don't get paid until 17, do I recognize that income in 16 or 17? 16, right? Because it has been earned in 2016. It matters when you earn it, not when you receive the income. So if we look at our facts right here with this taxpayer, if she was an accrual method taxpayer, instead of a cash basis taxpayer, how much income would she have in 2016 from Orange Corp? So remember, she billed them $5,000 in 16 and got paid for it in 17. Would that be recognized in 16 or 17? 16, right? Good night. And 0 and 17. What about for Blue Corp? Would she recognize all of it in 16 or all of it in 17? Again, all of it's going to happen in 16, which is when she actually earns the income. It doesn't matter that she didn't actually get paid until 17. Doesn't matter. Okay. There is an exception. There is something called the claim of right doctrine. This is when sometimes students get confused about this. This is an exception to the accrual method. So if you, and let's say I bill a client $3,000, and I'm an accrual method taxpayer. I send him the invoice at the end of 16. And he tells me, there is no way I owe you $3,000, which is all the time. You did not earn $3,000. You probably earned $1,200. I'm not going to pay you anything, until we get this figured out. Really, what this means is the amount cannot really be determined reasonably. Because the person who's going to pay you disagrees with what you're charging them. If there is really a dispute and it is not settled by the end of the year, you do not have to recognize that income until the claim is actually settled. Okay? There are two big exceptions I want to talk about. And I promise you one of them you will have a question on your exam that is very, very similar. Okay? So, two big exceptions with the accrual method that I want to talk about. One is for the advance payment of goods. This is when somebody pays you in advance. So let's say, there's a good example in the book. Brown Company will ship goods only after payment for the goods have been received. In December 2016, Brown received $10,000 for goods that were not shipped until January 2017. So, for financial reporting purposes, would you report income in 16 or 17 for this? It would happen in 2017 when the goods are actually shipped. Okay? What this rule says is if that's how you are reporting it, for financial reporting purposes, we will let you match it for tax purposes and not report it until 2017. Right? Even though you sent out the invoice in 2016, you received payment in 2016, really, whether you're a cash or an accrual method taxpayer, you should recognize it in 16. But under this rule, an accrual method taxpayer can match their financial for their financial reporting if it's for advance payment of goods. Keyword goods. This only applies with tangible goods. There is a separate exception for advance payment of services. Now, one thing I want you to remember with this exception is, one, it doesn't apply to goods, right? We just saw what the exception to goods looks like. And second, it does not apply to prepaid rents or interest income. Does not apply. That's an easy thing to forget, but this exception does not apply to prepaid rent or interest income. So this is when, let's say you have a service contract. You provide a service contract and say, I will provide services on your cable or whatever, your cable TV for 3 years, and your client pays for that entirety of that 3-year contract up front. So we know we have income recognition, right? We have paid, compensation for services. Our question is, when do we have to recognize that? We have a prepayment for services to be provided in the future. Okay? So we want to know, how do you have to recognize that income? Hold on. and this happens, there's a revenue procedure, it's 2004, that's 34, which kind of lays out this exception. And what we say is that you can basically extend out your income recognition for tax purposes, but only for the next year. So you can't go past the second year. So if your contract started in 16, you could only extend income recognition until 2017. You can include part of it in income in the year following receipt. So if you receive the payment in 16, part of it will be included in 16. And then part of it will be reported in the year following receipt, which would be 17. But not the year after that. Okay, we do have a cutoff. You can only defer income recognition up to the year following receipt. How much do we report in the current year? Only the amount that is earned in the current year. So let's look at what this looks like in an example. This is example 19. Yellow Corporation, an accrual basis calendar year taxpayer, sells its services under 12-month, 24-month, and 36-month contracts. On May 1st, 2016, they sell the following contracts. They have 12-month contracts, and they have total proceeds of $3,000. They have 24-month contracts, and there are total proceeds of $4,800. And they have 36-month contracts, which produces total proceeds of $7,200. One thing it doesn't tell you in the facts of this problem, which is important, is something that you really have to know, is that these contracts start on May 1st. In other words, I closed the deal on May 1st, and on May 1st is when I have to start providing services. If these contracts were sold on May 1st, but the contract said we will not be starting to provide services until January 1st of the next year, then you have no earned income from these contracts in 2016. Okay? It doesn't say that in the facts, but it is an important fact to understand. These contracts were sold on May 1st, and the taxpayer is required to provide services for the remainder of 2016. So we want to know, what is our income recognition going to look like for this accrual method taxpayer? So, all right. So, for the 12-month contracts, let's look at, hold on. Just making it. So we want to know what is our income recognition in 2016 and in 2017 from these contracts. So how many months are they providing services, or are they earning income in 2016? 8 months, right? Exactly. So that means we have $3,000 times 8 over 12, which equals $2,000. And the remainder is pushed into 2017, $1,000. 24 months. How many months are they earning this income in 2016? Same, 8, except what's our denominator? 24, right? So we have $4,800 times 8 over 24, which equals $1,600. The remainder is pushed into 2017, which is $3,200. Notice, we can't push anything into 2018. Okay? So, this is as far as we can go. Under the general rule of an accrual basis taxpayer, you know, this is as far as we can go with this exception. Now we have our 36-month rule. Okay, so we have $7,200 times 8, right, over 36, which equals $1,600 again. And the remainder of $5,600 will be pushed into 2017. You don't even have to do the math for 2017. All you have to do is just take whatever is left and recognize it in 17, because that's as far as you can go under this rule. And note, please remember, this rule does not apply with prepaid rents or interest income. You always have to recognize them in the year that they are received, for both the cash basis and accrual method. There's also hybrid methods, which I'm just going to give a little shout out to, okay? There are some combinations of these methods, which you'll see, you know, some of these, like, I know for contractors and stuff, they may use like a percentage of completion method, something like that. But we're not going to spend any time talking about the hybrid methods. Couple miscellaneous items related to income. Income from personal services is taxable to the person who performs the services. You cannot, I can't say, okay, you know what, I have decided I'm going to give my paycheck, or what I received from my paycheck, I'm going to give my paycheck to Katie, right? To Katie this month, because I'm a nice person. But I can't make Katie pay the taxes. I still have to be the one to pay the taxes because I'm the one who's earned the income. You cannot assign away that obligation to pay the taxes on the income just because you give the income to somebody else. If you're the one that earns it, you have to be the one to pay the taxes. And they come up with this called the fruit and the tree metaphor. It's because it's from a famous court case. Which says that the fruit has to stay with the tree. If I am the one who earned the income, I'm the tree, my paycheck would be fruit, I'm the one who has to pay the taxes. And this the very same concept, income from property is taxable to the owner of the property. This came from a famous court case where we had a bond. A coupon bond. And bonds used to have literally coupons attached to them back in the day when things were in paper and not all electronic. And there would be these coupons attached to them. And when you had earned your interest, you would cut the coupon off and then you would take it to whoever issued the bond and they would pay you your money. Okay? And what had happened was we had the taxpayer in this case. He was giving the coupons away to his daughter and arguing that the daughter should be the one that should pay the taxes on this interest income. And the court said, no, the fruit stays with the tree. So the bond is the tree, the coupons are the fruit. And so that means, Father, you're the one that has to pay taxes on this interest income. In criminal procedure, there's a similar concept, except it's called the fruit of the poisonous tree. which is kind of related, that if you have evidence that is obtained illegally, you can't admit it in court. It's poisonous or whatever. Similar, they actually borrowed from the tax world when they came up with that, which never happens. But anyway, so interest income. We're going to talk about interest income for a minute. So interest income accrues daily. That's what the code says. Interest accrues daily. If interest-bearing instrument is transferred, just like in the case I was just talking about, you have to allocate interest income between the transferor and the transferee based upon the number of days during the period that each owned the property. So this is not like a father clipping off the coupons of the bond and giving them to his daughter. This is the father is selling the bond. So he is selling the tree and the fruit to his daughter or to somebody else. Okay, this is selling the actual tree. So what we want to know, if you're selling the tree, who has to include what interest in income? So you have to allocate it based upon the periods that the transferor and the transferee owned the bond or the tree, the income producing property. So if we look, there's an example, 21. Floyd, a cash basis taxpayer, gave his son Ethan corporate bonds with a face amount of $12,000. So we have a $12,000 bond with a 5% stated interest rate, annual interest rate. The gift was made on February 28th, February 28th, 2016, and interest is paid every quarter. So for the transferor, we want to know how much interest income are they going to have. Okay. So we have $12,000 times 5% times 4/12, because there are 4 quarters in a year. And how many months of that quarter did the father own the bond? 2, right? So 2 out of 3. So it's paid once a quarter, right? 4 out of 12. There's 4 quarters in a year. And it's the father owned it for 2 months out of the first quarter. So the father is going to have interest income of $100. So see, in this problem, we have a father, and he is giving not just the interest, right? He's giving the entire bond. So that is why we are allocating the interest income and saying father will have to recognize $100 for the transferor of interest income at the time that he transfers the gift, and the transferee will recognize the rest. Last concept for today. Dividend. Dividends do not accrue on a daily basis like interest does. When are dividends paid? Whenever the corporation paying them decides they want to, basically. Okay, whenever the corporation decides we're going to declare a dividend, that's how you know, good, there's going to be a dividend. That's always nice. Okay, so who has to pay taxes on the dividend? Obviously, it's going to be the person who receives it. It's going to be the shareholders are the ones that are going to receive dividends. Okay? But that, you do get into some tricky questions. Because very often, you will have a declaration date of a dividend. So we have a declaration date. So this is when the corporation declares, hey, you know what? We are going to issue a dividend. And then we have, hold on a second, let me make sure I called the right thing. Record date. Record date. Okay. So we have our declaration date, and then we have our record date. It's right there on the board. What happens if you have so obviously the dividend's declared here, and then we have our record date. So what happens if you have a sale of shares between the declaration date and the record date? Who has to pay taxes on that sale? Okay? So, and I always get it confused. When is it what? Okay? Hold on. Be sure you write it down so you don't forget it and you put it in your notes for your exam, because I always forget it. So, if you have a sale of shares, the purchaser, if you have a sale after the declaration date, but before the record date, the purchaser of the shares is going to be the one that pays the taxes on the dividend, because at the time that the dividend is actually paid, they are the ones that are holding the shares. Okay. But what about if we have shares that are gifted after the declaration date but before the record date? Now the rule is opposite, and the donor, so the person giving the gift, has to pay the taxes on the dividend, even though it is really the recipient or the donee who is receiving the cash. There is another date that is important. It is called the ex-dividend date. What happens on the ex-dividend date? There's a footnote on the bottom of page 414 that describes the ex-dividend date. It is the date before the record date on which the corporation finalizes the list of shareholders who will receive the dividends. So it is after the declaration date, but before the record date. Why does this date matter? Okay, we're going to talk about why this date matters. Remember in the last chapter, we talked about something called preferential rates for capital gains. This means if you have long-term capital gains, and you are an individual, you have a tax that is lower than your tax for ordinary income. And if you are basically in the 39.6 bracket for 2017, you are taxed at 20%. If you're in the 15% and below, you are taxed at 0%. And if you're in the middle, you're taxed at 15% for capital gains. Remember? All right. The same rates apply to dividends. Okay, we have the same rules for long-term capital gains as dividends. So if you're receiving dividends, you have the same rate bracket as long-term capital gains, so long as you have a qualified dividend. Qualified dividend receive preferential rates. Great. What is a qualified dividend? Okay. First of all, it has to be a dividend from a domestic corporation. Cannot be a dividend from some tax-exempt organization. Okay, so it must be a domestic corp. And, this is the big one, the holding period must be met. The holding period must be met. So what is the holding period? The stock must have been held for more than 60 days during the 120-day period beginning 60 days before the ex-dividend date. So we have that ex-dividend date. It must have been held for 60 days during the 121-day period that starts 60 days before the ex-dividend date. So if you have not held the stock for this long, you are not going to get these lower preferential rates for qualified dividends. So if we look at example 23 in the book, there's a good example of what this holding period looks like. In June 2016, and I will tell you on your exam, and I'm pretty sure on your homework too, I'm not going to ask you to calculate this holding period requirement. I will tell you the holding period requirement either has or has not been met. Okay? In June 2016, Green Corp pays a dividend of $1.50 on each share of its common stock. So we have $1.50 per share dividend. Madison and Daniel, two unrelated shareholders, each own 1,000 shares of common stock. So we have Madison, 1K, and we have Daniel, 1K shares. Consequently, each received a dividend of $1,500. Daniel satisfies the holding period, but Madison does not. So we have Madison receiving a $1,500 dividend and Daniel receiving a $1,500 dividend. Okay? So that means that Madison's dividend is taxable at ordinary income rates. So if Madison is in the 30% tax bracket or 33% tax bracket, it would be $1,500 times 33%. If Daniel meets the holding period requirement and he's also in the 33% tax bracket, his dividends are taxable at 15%. So he will pay taxes of $1,500 times 15%, whereas Madison will pay $1,500 times 33%. Okay. I will say, go back and look at example 25 in the book. There is an example of how this works, not this, which is why I want you to go back and look at it yourself because I've already erased it off the board. How it works when we have a gift versus a sale between the declaration date and the record date. It's pretty simple, but I want you guys to go back and look at it since I've already erased it off the board. Example 25.